We also saw the cedi appreciate 42%, supported by what has now been a trade surplus of $13.5 billion, driven by significant gold exports. It's worth noting that our net reserves, net international reserves, now at $11.7 billion, is significantly larger than what our gross reserves were in 2019, before COVID. That we've never seen this kind of level of reserves in terms of buffer, and that should give confidence to all of us going forward. The key question now is sustainability. And clearly, whether or not these gains would actually continue would require physical discipline, structural reforms that would expand Ghana's productivity, and critically, develop a deeper and more liquid capital markets. As investment professionals, we cannot afford to be passive observers in this market. We must contribute to the evidence-based insights that translate to stabilization for durable economic progress in the markets. Against this backdrop, we are honored to invite our special guest, the Chief Executive of Ghana Stock Exchange, whose leadership continues to be central in the capital markets development and in the market confidence in Ghana. We had a significant record return for the Ghana Stock Exchange last year, and I do hope that when we have the panel discussion, the panel will delve into how investors can leverage on what is happening in the Ghana Stock Exchange to support the overall economy as well. We'll also hear from our market forecast speaker, the Chief Investment Officer at Axis Pensions, who will share valuable insights on outlooks on markets and the investment landscape in the year ahead. This evening, we would also celebrate excellence. It will be a pleasure to honor 11 outstanding professionals who have successfully completed the CFA program and fulfilled all the requirements to earn the right to use the CFA designation. The CFA Charter represents discipline, resilience, ethical commitment, and intellectual rigor. You have persevered through demanding examinations while balancing careers and personal responsibilities. And on behalf of the society, we are immensely proud of you and warmly welcome you to the global community of CFA Charter holders. No professional organization thrives without service. From July to December, our volunteers have dedicated significant time and efforts across advocacy, membership, education, and finance committees, delivering initiatives that strengthen stakeholder engagement, enhance learning outcomes, and improve the society's governance and financial stewardship. To our volunteers, many of whom have served quietly behind the scenes, please accept our sincere appreciation. Your commitment reflects the very best of CFA Society Ghana. To members who have not yet volunteered, I would encourage you to step forward. Volunteering is not only a way to give back, it is also an opportunity to build leadership skills, broaden professional networks, and help shape the future of Ghana's capital markets. As we look ahead, let's remain optimistic, but also disciplined. Let us commit to the highest ethical standard, constructive engagement, and active participation in Ghana's economic journey. This evening, I invite you to engage openly, share perspectives, and enjoy the fellowship of colleagues united by one common purpose. Thank you for your time and your commitment and your continued support for CFA Society Ghana. I wish you a most enjoyable and insightful evening. Thank you.
Thank you very much, Jojo. Please let's give him another round of applause. Our president who's been leading the charge, leading from the front and making sure that the deeds are done for this great society. As you would know, the CFA Society is the CFA Institute is an international body, and the Ghanaian Society, that's the CFA Society Ghana, belongs to a bigger group. We want to get a goodwill message from the leader of the CFA Institute. So ladies and gentlemen, within the next few minutes, we'll take a goodwill message and remarks from President and CEO of the CFA Institute, Mark Franklin, CFA.
Hello, I'm Mark Franklin, President and Chief Executive of CFA Institute. Happy New Year. I wish you, your families, friends, and colleagues all the best for the year ahead. If we learned anything from 2025, it's that the world remains as unpredictable as ever. As we enter a new year, the pace of change in the investment profession continues to accelerate. Technology, and especially AI, is transforming how we work and how our candidates and members work. Client expectations are shifting, and the definition of value in markets, portfolios, and professional performance is being rewritten in real time. At CFA Institute, we see this moment clearly, and we're embracing it as an opportunity to lead. We continue to listen to the signals around us from our members, employers, regulators, and candidates. Across regions, the message is clear. Professionals want learning that is career relevant, demonstrates competence and job readiness, and is flexible. They want tools and support that evolve alongside the demands of and the disruptions to their roles. And they want to belong to a global community that reflects the dynamism of our profession. So for us at CFA Institute, 2026 will be a year of action. We will continue to advance how we deliver learning, integrating AI tools and AI-enabled processes where we can. That means a more personalized, digital-first model built around real-world skills, from Python and due diligence to assessing climate risk to the ethical application of AI. Our learning offerings are evolving to reflect the structural and societal transformation we are witnessing. We continue to evolve the CFA program, and we're updating and evolving our products and resources tailored to every stage of a professional career journey, from early career through to senior leadership roles. We're working with leading firms in our industry to deliver onboarding and upskilling solutions that bring real value to their workforce. Employers want job-ready talent. Professionals want career advancement. We are the bridge between the employer and the professional. We're also deepening our efforts to localize our products. We're more committed to making them more accessible around the world. We take seriously the vital role we play in advancing the conversation around the most pressing issues in global finance. Through our Research and Policy Center, we're producing actionable insights on topics like AI integration, private markets, tokenization, and sustainable investing, connecting theory with practice to elevate decision-making across the profession. Our convening power remains unmatched globally. Through industry roundtables, regulatory consultation, advisory councils, and high-impact events, CFA Institute continues to be the place where financial professionals come together to solve real problems, raise standards, and shape policy with integrity. In 2026, we will welcome a broader audience of professionals into our global network. With the launch of associate membership, our community will expand to include early career individuals who have demonstrated a commitment to ethics and professional growth. This new entry point reflects both where the profession is heading and our responsibility to help shape it with integrity from the start. With our strategic vision for 2030 in place, we're moving ahead with speed and purpose, but also with clarity, ethics, education, and professional excellence remain our foundation. Yes, the challenges ahead are daunting, but we know CFA Institute brings the profession together, raises standards globally, and supports individuals who want to make a difference in the world every day. So, whether you're a charter holder, a candidate, an employer, or someone exploring a career in this field, thank you. Thank you for being part of this community. From all of us at CFA Institute, we wish you a healthy, purposeful, and fulfilling 2026. Be well.
Thank you. It's indeed our hope to see this industry grow from strength to strength. That's why it's beautiful to see that industry participants make it a point to bring their resources together to make programs like this successful. We are happy to acknowledge our sponsors for today's event. These are institutions that we are very familiar with, and it's good to see that they continue to push the drive towards building a great industry for Ghana. Our sponsors for today are IC Securities, or the IC Group. Please let's give it up for IC. We also have DataBank Group as one of the sponsors for today's event. We are also privileged to have Standard Chartered Bank as a partner for this event. Please give it up for Standard Chartered as well. As the program goes on, I'll give you more insight on these great institutions who have come together to make sure we have a good event. Talking about institutions, there's one that is very much at the center of what we do as investment professionals and financial markets professionals. This institution happens to be led by someone we've come to love and admire. I call her an icon. She was appointed as the Managing Director of the Ghana Stock Exchange in November 2022. She's worked in the capital market industry for over 20 years and is highly respected for her technical knowledge, business acumen, outstanding professionalism and integrity. She was elected as a board member of the International Capital Markets Association, ICMA, in June 2025 and serves as a co-chair of the Pan-African Committee for the same institution. In 2023, the World Federation of Exchanges named her as one of the global top 20 women leaders. She also serves on the executive committee of the African Securities Exchanges Association. She has broad boardroom experience gained from serving on the boards of organizations such as the Central Securities Depository Ghana Limited, Minerals Income and Investment Fund of Ghana, Access Bank Ghana PLC, Coronation Asset Management in Nigeria, Cosmos Energy Ghana, the Foschini Group in Ghana, Ghana Venture Capital Trust Fund, the University of Ghana, the Ghana Petroleum Stabilization and Heritage Funds, and the African Women's Development Fund. I'll have to catch my breath after mentioning all those boards. She's previously worked as a senior advisor with the Black Ivy Group LLC, Renaissance Group, where she was CEO of the New World Renaissance Securities Limited and head of investment banking and finance in West Africa, ex-Nigeria, for Renaissance Capital, and Strategic African Securities Limited, where she was executive director. She's an alumna of the University of Ghana Business School. In 2023, she was awarded an honorary doctorate degree by the University of Ghana for her immense contribution to the industry. I must say that she doesn't throw that doctor title around, so GTech has nothing on her. She's also undertaking academic and leadership studies at the global institutions such as the Stanford Graduate School of Business and Harvard Business School. Ladies and gentlemen, by this time you know who we are talking about. Please, let's welcome our special guest, the Managing Director of the Ghana Stock Exchange, Ms. Abna Amwa. Please, let's hear it for her.
Phew, that was quite a mouthful. I always get embarrassed when you're reading about me that way. But Mr. President, Jojo, the board of CFA Society, distinguished guests, ladies and gentlemen, industry colleagues, a special shout out to the newly awarded charter holders. Good evening to you all. Good evening. We are still in January, so I take it that it's not too late to say Afio, Afe. No response. Afisha Pao. Okay, thank you very much. I'm honored to join you all this evening. This is one of those events I look forward to every year because I get to hear from people smarter than I am about your forecasts for the year ahead. And it energizes me and gives me what to do to meet your expectations. So thank you so much again for inviting me. And I'm especially thrilled to see that my own IC Securities and Data Bank brokerage are lead sponsors for tonight. I think they deserve another big round of applause. I've been invited to share a few brief comments, and I'm not going to go into where our economy has come from because there are way more bigger experts in the room than I am. But Mr. President, as I was listening to you call the CFA holders, I heard Margaret CFA, and I wondered, Abnamua, FCFA. Now that is a title I wouldn't mind bandying around, so please consider me. Award me with a fellow CFA charter holder. If nothing at all, hopefully you can invite me to your board so that the gender there too, we can improve it a little. But that is something I hope we can work towards. Our economic resurgence is something we are all pleased to see. And for us at Ghana Stock Exchange, this resurgence for us is an opportunity to deepen the capital markets, to broaden product offerings, and mobilize patient capital for infrastructure, for businesses, for national economic development, and for personal wealth creation. And that is why our focus remains on market integrity, innovation, and for us creating an environment where your products can come to the market and investors can have confidence to invest in the products that you create. I want to therefore take this opportunity to commend the CFA fraternity for your immense support to the GSE, especially for what we think was a successful, incredibly successful 2025. As all of you know, because you are the analysts, the Equity Markets Composite Index returned 79% as at the end of 2025, the largest in 21 years. And whilst they say it makes us one of the best performing exchanges in Africa, I think we were one of the best performing exchanges in the world, period. Drop mic. The Financial Stock Index, of which many of you in here work for, companies that are in the index, returned 95%. And it's only in Ghana that post-DDEP, that hit banks. And we saw some write-offs we hadn't seen before in 2022 and 2023, that banks will bounce back so much that our FSI, our Financial Stock Index, attained almost 100% in 2025, recording its highest return since we introduced that index in 2011. On our fixed income markets, we recorded a record 245 billion volume of securities traded, a 41% increase over the 174 billion in the same period for 2024, and exceeding the highest we had ever attained, which was pre-DDEP of 230 billion. This is the Ghana market you are creating. We, through collaboration with the International Capital Markets Association, we held the first West Africa Bond Market Conference, bringing regional investors and talking about how to rebuild our markets. Ladies and gentlemen, last year was incredibly successful in terms of how we supported issuers to raise capital. The first ever commercial paper on the GSE came through Federated Commodities PLC. The first commercial paper on the fixed income market came, and Federated Commodities continues to see how they can expand their program on the market. Cal Bank at the end of the year raised 900 million in a successful rights issue, and the icing on the cake was to have First Atlantic Bank PLC officially list on the exchange, breaking our 7-year equity market IPO drought. How we have the best brains in the room and we can't do IPOs. We broke that last year. And as I requested, monthly, the GSE bell has to ring. By tomorrow, we should get a new listing because January has been quiet. And if you don't make it by tomorrow, in February, you better double it. Thank you very much. But whilst I celebrate these successes, and they are worth celebrating because they are testaments to the hard work all of us have put in over the years to create these success stories, I also consider that all these successes have come on the back of a very, very shallow market. A very shallow market. On the equities market, we have 35, 36 companies listed. There are thousands of companies registered in Ghana. Ghana Club 100 alone has 100 companies. We have one ETF, an exchange-traded fund. Just this morning, my colleague CEO in Tanzania shared great news for me that whilst I was celebrating, it was humiliating as well. Tanzania just launched their first and listed their first regional ETF that gives Tanzanians exposure to all the stocks or key stocks in the East African market. I hope there's no Tanzanian in the room, but little Tanzania. They are not our co-equal, right? They have done it. So what am I own doing? Infrastructure bonds, Nigeria, Cote d'Ivoire, they are issuing and listing them. Green bonds, they are issuing and listing them. Ghana. This is what I want us to address. So when we are celebrating our successes, we've had 200 companies, 200 products coming from my best brains, coming from my most energetic people. Innovation that creates products, funds across industries, and that create value, the value that leads to the wealth creation and the economic transformation and the big bonuses for all of you. So thank you very much for inviting me this evening, and I look forward to learning from all of you, but importantly, working with you. I'm here to facilitate. Let myself and my team know what products you want to bring. We will facilitate from the policy makers, from the infrastructure perspective, from the rules perspective. We will create that enabling environment so you are wealthier, we do well, and Ghana collectively, we do well. Thank you so much again for inviting me, and I wish all of us a lovely evening.
We can do it better for Ms. Sabina Amwa. One thing I've learned over the last few years is not to take for granted forecast events, forecast webinars, forecast programs. Because if you've been to this event over the last, at least over the last 3 editions of this event, and you've looked at what's happened in the market after, you would know that there was real value that was shared over a year. Of course, they'll be very modest about it and say, this is not investment advice. But trust me, there's a lot of good value that is shared over a year. That's all I can say. From the last 2 years, I believe AJ gave us that power-packed presentation. Then I think we're at the African regions. Yes. at that ceremony or at that event, he talked about AI when a lot of people had to Google that for the first time. And boy, what a prediction. In fact, what a prophecy it was. Because for those who were exposed to those markets, I can say people ate good. Last year, Emmanuel was here, and he shared some great insights. And I think if you were here at that event as well, you would have found that very beneficial, to put it mildly. This evening, we have another opportunity to hear a forecast of 2026. Let me say it even before he says it. Yes, this is not investment advice, but trust me, there will be real value. Our forecast speaker for tonight is a seasoned investment professional with over 2 decades of experience in global financial services. He's currently the Chief Investment Officer, Axis Pension Trust, and General Manager, Axis Wealth Management Limited, where he leads both the pensions and wealth management practices. In this role, he plays a central part in client portfolio construction while providing strategic guidance and mentorship to the investment team. He began his financial services career in London, UK in 2002, moved to Delaware, USA in 2004 for graduate school, and worked with several global and regional investment banks as well as asset management firms before joining Covenant Wealth Strategies LLC USA as the investment research manager, where he supported the investment team and led the firm's research function, contributing to disciplined, research-driven investment decision-making for over 13 years. He's a graduate from the KUST and with BA Hons and Honors in Economics and Sociology degree. He's also a CFA holder. Ladies and gentlemen, please put your hands together for our forecast speaker for tonight, Mr. Peter Bewa, CFA.
Thank you, friends, for the introduction. I was wondering who you were talking about, but I guess I'm the only Peter in the room, so I'll take it. I just want to start by thanking the CFA Society Ghana for inviting me to share mine and Axis Pension Trust thoughts on the markets. I was looking forward to just attending this event in person for the first time after joining virtually the last 3 years, and then I was asked to give the forecast. So nice way to initiate me to Ghana. I appreciate it. So I'm going to try to kind of cast a bit of a crystal ball for 2026. But before I do that, I want to kind of do a quick review of 2025 on the global markets before we look at what's going to happen this year. Obviously, we don't know everything that's going to happen, but based on what we know now, we're going to share what we believe. So I know the screen is kind of big, it's all around me, but the agenda will be to talk about 2025 global market review, and then go on to 2026 outlook before we delve into the Ghanaian economy. All right, so 2025 was very, very volatile to a very large extent. There's a lot of uncertainty coming into the year. However, we saw a very strong market performance. So some of the factors that contributed to 2025's performance, we had a stable inflation environment. And most of the data is going to be based on the US market. That's the biggest economy in the world. When the US catches a cold, or when the US sneezes, the rest of the world catches a cold. And so I'll start from the US and then go to developed international and then emerging markets, and then we'll come to Ghana. So we saw stable inflation. It was range bound between 2 2.4 and 2.8% throughout the year. And so whereas, post-COVID inflation rose up to about 9%, it came down the subsequent years, and then in 2025, it stabilized below 3%. So that was a good macro factor. We also saw very strong market performance. So the S&P returned about 17% for the year. If you add dividends, emerging markets was the best performing sector. They returned 34%. And then developed international, which is outside of the US, so Europe and Japan, returned about 32%. So by all indications, the global markets had a strong year last year. GDP was really strong in the US market. So the largest economy in the world, growing around 3% for the year, was very strong. Q3 numbers was just revised last week to 4.4 from 4.3. So by all indications, very strong GDP numbers, and that by no means, shows there's no recession on the horizon anytime soon. We also saw interest rates trending down. So the Fed cut rates 3 times last year, and so that brought interest rates down. Corporate profits were really strong, and so Q3 earnings season, over 81% of the S&P 500 components beat earnings forecast. We're still going through the Q4 earnings season. So far, about 80% have beaten, but they're still reporting. Actually, this week is the heaviest for earnings releases. About 125 companies in the S&P are reporting this week. And so far, earnings have been strong for 2025. The biggest negative factor that we saw last year was unemployment crept up slightly. So it went from about 4.2 beginning of the year, ended the year around 4.4. And so we saw the job market kind of weak a little bit, but it's still contained below 4.5%, which is really, really good. And then coming into the year, the biggest risk we talked about was Trump's trade and tariff policies. That played out exactly the way we predicted. We saw what happened with the Liberation Day rhetoric. Markets pulled back around 20%. But subsequent to that, any more, such pronouncements, the markets reacted, less volatile. And so that trade and tariff uncertainty caused a lot of jittery in the markets, and that was where we were as far as 2025 goes. So those two bottom points were the negatives, as far as 2025, but we still saw a very strong market performance. So this chart shows the various asset classes in the global market. Every single asset class for 2025 was positive. And so like I said earlier on, emerging markets was the best performer, up over 34%, followed by developed international, up almost 32%, before the US large cap markets. We see commodities somewhere in the middle, and then the worst performing asset class was REITs. But so this is, every calendar year since 2011. One key takeaway from this particular slide is that a well-diversified portfolio, which is the one in the middle, the white one, asset allocation, it has always had a good return for the year. It might not be the best performing, part of the chart, but it's never the worst. And so diversified portfolios have always done really well. The next slide also goes to corroborate the previous one. It also has just the Q4 2025 numbers, and that shows commodities, having a very strong fourth quarter. But overall for the year, emerging markets, dominated. This particular slide delves into the various sectors within the S&P. So the S&P is made up of 11, sectors, and we can tell from the middle part of the chart, the best performing sectors were communication services, technology, industrials, and utilities. Okay, and those were the major drivers in the performance of the S&P 500. However, there's concerns about the markets being overvalued. And this chart, the bottom part of the chart, also shows how the forward P's of the various sectors compares to the overall market. So the fourth from the bottom line, at the end, you see 22 times P for the S&P index. Now, if you scroll to the middle, you realize that we have about 5 sectors that are undervalued versus the S&P. And so you look at financials is 16 times, energy is 15 times, real estate is 16 times, utilities is 17 times. And so in spite of the fact that the markets in general are overvalued, there's still sectors that are undervalued. And we see a lot of opportunities in those areas. So the valuation concern, is major. The markets have been overvalued. This graph shows that if you take out the top 10 companies within the S&P, the bottom 490 have a lower PE than the broader market. And so while the top 10 is showing 28 times PE, the remaining companies is 19. The right-hand side of the chart also shows the contribution of the top 10 companies to overall earnings in the S&P. So whereas the market cap for the top 10 is about 40%, they're contributing 32% of the earnings growth within the S&P. That clearly shows that there's other parts of the market that have a lower PE ratio and have the opportunity to contribute, towards the growth in the S&P 500, and that's where the opportunities lie. There's talk about the Mark 7. The Mark 7 during COVID, or post-COVID, contributed about 80% of the earnings growth in the S&P. But clearly, if you look on the right side of the chart, when you take all the Mark 7 and their earnings performance, you can tell from 2023, it's come down to about 24% in 2025. So what does that mean? The dominance of the Mark 7 in the S&P 500 is dwindling, and that portends a lot of opportunities in other sectors in the industry, in the index. That's where the opportunities are. And so we've seen, since 2023, we've seen a broadening out of the broader S&P 500, where just a few companies were responsible for carrying the whole index. Now we've seen other sectors such as utilities, financials, industrials, also experiencing some of this market growth, and that is where we find opportunities going forward. So that was for 2025. Now looking in 2026, I'm going to start with where we are, currently. What's the macro backdrop? So as of now, we're still in an environment where inflation continues to be stable. So December PCE numbers came out at 2.8. It's still below 3%. One of the factors that has made inflation kind of sticky within the 2.5 to 2.8 range is a change in the components of inflation. So whereas during COVID, the biggest component in inflation was actually energy, and there's a slide that will show that. Let me go there so we can put it in perspective. So in June 2022, the biggest component of inflation was energy due to supply chain constraints. Now, when supply chain issues eased, inflation the components came back to what it was post-COVID. Currently, the biggest component in inflation is shelter. Now, shelter cost doesn't come down as easily as other supply chain issues. And so, whereas energy prices came down drastically and brought inflation down from 9% down to around 3%, it takes a while for shelter costs to come down. When you sign a lease, it's usually for at least a year, sometimes 2 years. And when you sign the lease, that is going to stay constant until you sign the next lease. One of the things the Trump administration is trying to do, or policies they're trying to pass, is to make it easy for home construction, to come online very, very fast. And so they are putting in place policies to encourage home builders to build a lot of homes in order to bridge the deficit, the gap, between demand and supply. And that is going to drive down the cost of houses. And so we think that going forward is likely to see inflation get closer to the 2% range, even though it's not going to happen in a very, very quick, time. But we don't foresee inflation going as high as it was, post-COVID. So I'm going to go back to the macro factors. So that was about inflation. The second factor we see, macro factor we see, is central banks are in an easing cycle. So we saw the Fed cut rates about 3 times last year. This year, markets expect about 2 rate cuts. So that's going to continue to drive down interest rates. And that is always a good thing for the market. It boosts equity valuations. It makes borrowing, easier. And that, spurs economic activity. We also see the strong GDP that we experienced last year likely to continue this year. For an economy like the US continue to grow above 3%, that's phenomenal. And we think that, we're in a position to see that continue to grow. The biggest component of the US economy is consumers. Consumers make up about 68%, almost 70% of the economy. And consumers are in a position to continue spending. The Trump administration is likely to pass a stimulus from the tariffs that they received. And then they're also likely to, they've already passed the bill to extend the tax cuts, that were passed during his first administration. And so consumers are likely going to get huge tax refunds, next year. And that is all going to boost, consumer spending. They are also not a big fan of regulation. And so there's we're in an environment where, there's deregulation across industries. And that is good for sectors like energy and financial services. We expect to see a lot of M&A activities, going on. And so deregulation is also good for the markets. We're also going to continue to see strong corporate earnings. The biggest uncertainties continues to be trade and tariff uncertainties. Trump, being what he is, he's continuing to use tariff, to threaten trading partners, and that continues to be a big risk. However, Wall Street coined the term tackle trade, which simply translates to Trump always chickens out. So if history is anything to go by, this tariff, rhetoric has so far been used as negotiating tactics. He will stake out a very, very extreme position. He will negotiate his way to the middle, and sometimes it's a no deal at all. So that's what the markets are expecting to happen going forward. And so in spite of the fact that, it's still very, very, uncertain, we believe that eventually all that it gets worked out and actually creates buying opportunities. And so when the markets pulled back last April over 20%, that was the time to be buying. And for people that stayed in the markets, they made a lot of solid returns, and the markets ended up higher than they started. And so that's our perspective as far as Trump uncertainties, trade and tariff uncertainties go. And then obviously we continue to have geopolitical uncertainties. That is it's come to stay. As risk managers, we need to be aware of geopolitical tensions. It's always going to be there. And just when one issue is being resolved, 3 more are cropping up. And so we live in a world where we have to be able to manage our portfolios such that it's kind of insulated, around those geopolitical uncertainties. So that's the macro backdrop that we're in right now. And so with all that being said, we're going to take a snapshot of the US market. So we talked about, I'm going to talk about the negatives before we go to the positives. So we talked about sky-high valuations, right? So markets in general are overvalued. However, I also showed you sectors that are undervalued, where opportunities, lie, where we can actually, make some good investments. That what that simply means is that we are not in a situation where a rising tide is going to lift all boats. Not every asset class or not every sector is going to do well. That is where active management comes in handy. We need active managers to do the work to identify where the opportunities are. We also have another negative, what we call the Warren Buffett indicator. So Warren Buffett has his own way of, assessing how overvalued the market is. He simply compares the market cap of the whole S&P index versus US GDP. And if the S&P market cap is between 80 to 120% of the GDP, then it's overvalued in his perspective, which he's been right a lot of the times. Now, it will allow me to know that currently the S&P market cap is about 200% of the US GDP. So the overall market is overvalued. And so, like, being an index investor is not a time for that. You have to be selective. You don't have to be throwing, investments, in any asset class. You need to know what you're getting yourself into. And then the third negative in this current environment is the midterm elections. Midterm elections in the U.S. also, results in a lot of market volatility. There's a lot of political posturing. There's a lot of rhetoric, from both sides, Republicans, Democrats, saying all sorts of things, and that can drive the markets. However, it also presents opportunities. If Trump makes a tweet about a particular company and the fundamentals have not changed from yesterday to today, I mean, what does it mean? It's a buying opportunity. So those are the negatives to be aware of, as risk managers and as asset managers. Now the positives in this current cycle. So if history is anything to go by, anytime we have a major correction like we had last year, any subsequent corrections are muted. What does that mean? So last April, we saw the markets pull back about 20%. Now, if we have another correction this year, it is not likely to be as severe as we saw last year. And so if you look at long-term charts, you see the markets having higher lows. So the pullback from last year, if there's another low, it's not going to be to that same level. It's likely to pull back, less than last year. So that's a positive. That even if we have, a major pullback. The second positive is the fourth year of a bull market is usually a positive year. So we had over 20% return in 2023. We had another 20+% return 2024. Last year, we had about 17%, so it wasn't as strong as the previous 2 years. History shows that the fourth year of a bull market is also a positive year. So we may not have another, 17% or 20%, but we're likely to have another double-digit return this year, going by history. And then the third positive is also the fact that the second year of any Fed rate cut cycle is usually a positive year. So the Fed started cutting rates, last year, and this year will be the second year. Now, when rates continue to come down, it's always a boost for the market. So those are some of the positives, to consider whilst we make investment decisions. I talked about this inflation chart earlier on, and then also this shows the components of the GDP. So, like I said, the U.S. economy, 68%. Of GDP components is by consumers. And so consumers are very, very powerful. And anytime there's a stimulus or there's any tax cuts, it's always a boost for the market. So where do we find investment opportunities? I talked about the U.S. markets being overvalued, but there's still opportunities in the U.S. The U.S. is still the biggest economy in the world. So the U.S. is showing very strong GDP growth, and so that is a place to continue to invest in. We at Axis, believe it's good to trim allocation to the U.S. and put some in emerging market because of how the valuations are. But the U.S. is still the #1 place to invest in this current environment. The U.S. continues to have a stable inflation environment. They're in an easing cycle. There's strong corporate earnings. Valuation concerns, like I mentioned, is a negative. And then the midterm elections. But the US is still one of the favorites. We see opportunities in developed international, which is, developed Europe and Japan. So one of the results of the Trump administration's policies, has led to increased spending in defense and also infrastructure spending. And so countries like Germany, Britain, France, and other big economies have increased their spending in defense because they cannot rely on the US, to support NATO like it's done in the past. And that creates opportunities in industrials as a sector. In addition to infrastructure spending. Developed International also has better valuation. So last year was the first year in over a decade that those markets outperformed the US. So whereas valuations in the US overall are stretched, those markets have been, depressed as far as valuation goes. And so you can get good assets cheaper than in the US. The developed international region also continues to have, stable inflation environment and their easing cycle. The negatives in that part of the world is that their populations are aging. So whereas, like emerging markets has a very, very young population, developed international, have a very aging population. And so the consumer growth is not as strong, consumer spending is not as strong going forward. But as far as defense and infrastructure goes, that's where to invest in. And then we come to emerging markets. So post-COVID, due to supply chain constraints during COVID, where so over the last 4 to 5 decades, China has essentially been the manufacturing hub of the world. Now during COVID, because of the lockdowns and supply chain issues, a lot of economies, got handicapped because they couldn't get their supplies to feed their factories and other, economic activities. So one of the things that came out of COVID was that other countries wanted to bring manufacturing back to their shores, and so that has led to what we call reshoring. So even companies in the US have invested a lot to build factories in places like India, Brazil, Vietnam, Mexico. And so that has led to investment opportunities in those parts of the world, in emerging markets in general, outside of China. Emerging markets also has very, very young and favorable demography. And so the populations are young, and that gives a very long runway as far as consumer spending goes. The valuations in that part of the world are very, very attractive compared to the US. However, geopolitical tensions tend to plague that part of the world, more than other parts of the world. And then obviously the trade and tariff uncertainties, from the Trump administration. Just yesterday or 2 days ago, he was back accusing South Korea of not, honoring their trade agreement they had last year, as far as bringing investments to the US. And so I don't know if it's going to increase the tariff on South Korea again. But like I said, eventually all these, tariff talk, leads to negotiations, and eventually it all gets worked out. But in the interim, those continue to be one of the risks, investing in emerging markets. But we think that the performance from last year is likely to continue this year as far as emerging markets go, and so we like emerging markets a lot. So with all that being said, we're going to talk about the sectors that we like, after we combine all the various, charts that we already looked at. And so as far as tactical investing, tactical opportunities go, we are overweight to communication services. So there's the ongoing shift to ad spending. We all continue to see advertisements on our phones, on all of our PCs. Anytime you have a conversation with your colleague or your spouse at home, the next thing you know, there's an ad tailored to you on your phone. There's 2 major sports events this year. So we have the Winter Olympics coming up. We also have the World Cup coming up. That's all going to drive ad spending, and that makes communication services, one of the sectors that we like. The midterm elections, you're going to see, Facebook ads, political ads all the time, and the AI monetization. And so those all make comm services one of the favorites. We also like financial services. I mentioned, lower interest rates. That makes borrowing cheaper, and banks make, money from borrowing and so, or from lending. And so when rates are low, banking activities, kind of improve. With the deregulation now we expect from the Trump administration, that is also going to spur M&A activities, which is good for financial, services companies like the investment banks and companies like that. And so we like financial services a lot, if you add the fact that it's trading at a lower valuation compared to the broader markets. We continue to like technology. Obviously, AI, I keep saying we are, still in the very early innings. And so AI is going to continue to drive the tech space as far as, earnings growth goes. We like to be diversified within that space, and so, you don't want to own just the chip manufacturers. Like, that's the first iteration of the whole AI play. But there's also the software that supports, the chips that are being manufactured. And then you also have the third iteration being the data centers that are being built to support the whole AI infrastructure, and how companies that are managing these data centers. And then the utility, suppliers, that's a huge market on its own. There's not enough energy to supply all these data centers. There's now talk of augmenting the traditional energy sources with nuclear energy and other renewable sources of energy. So those are long-term plays. And then the final iteration will be the sectors or the companies that are actually incorporating AI to improve efficiency. So AI we're still in the very, very early innings, and that's going to continue to drive tech. And the fourth sector that we like is industrials. So I talked about increased defense spending. We talked about reshoring and industrialization, and then also data center build out. So these are the four main sectors that we like. As far as the middle, so we are market weight, with these sectors. So consumer discretionary, utilities, healthcare, staples, and energy. Discretionary because consumers are going to be in a better position next year with the tax cuts being extended, with tariffs, stimulus, being passed on to consumers. And then utilities because of the demand, from the AI infrastructure. And then we are underweight materials and real estate as far as, sectors go. On the fixed income market, so broadly speaking, with rates, coming down and expected to continue to go down, we want to extend our duration so that if we can take advantage of any price appreciation. But as far as the actual asset classes within the fixed income space that we like, we want to have high quality investment grade, that will insulate your portfolio for any major economic hiccups. And so we believe in high quality. We also like securitized, assets such as mortgage-backed securities and collateralized debt obligations. We like municipal bonds in the U.S. because of the infrastructure build-out. And so the municipalities are usually the ones that actually carry out the infrastructure development. And then we like emerging market debts because of the opportunities that, we see within that space. And then we also like commodities, as a way to diversify, our portfolios. And so commodities continue to have low to negative correlation with other asset classes. I know gold had a very, very strong year last year, but silver did even better than gold, believe it or not. We think that trend is going to continue this year due to, the Trump policies in general. So whereas in the past, flight to quality, meant buying U.S. treasuries, now with what is going on with Trump, treating trade partners the way he is, people don't want to buy treasuries anymore, so they rather buy gold. And gold is also being used to show up, domestic currencies. Like we saw here in Ghana, other central banks are doing that around the world. And so the demand for gold is going to continue going up. As long as, Trump remains in power, I think that that's going to be one of the asset classes that's going to help hedge, major currencies and economies around the world. Silver and copper are not just a store of value like gold, but there's also industrial use for those commodities. And so we think that that's going to keep, driving up. And then rare minerals, with this whole EV phenomenon and, other new technologies coming up, rare earth minerals are going to be, a long-term play. There's other, alternative asset classes, but the commodities are where we want to be, in this cycle, as far as our practice goes. So that's for the global markets. And now I'll do a quick, quick recap of the Ghanaian economy. And I know, the panel is going to delve more into the Ghanaian market, but just a quick review. So 2025, we saw a very strong economic rebound, in our, Ghanaian economy. We also saw the currency rebound very strongly. I think this is the best performing year well, as far as I can remember. I don't remember the cedi doing so well against, any other currency, especially the dollar, in a very, very long time. So that was really, really strong, numbers. We also saw the equity market, as our guest speaker went over with us. The equity markets returned over 70% for the year. It's the strongest in over 20 years. We saw inflation come down sharply. If you compare the previous year to last year, it was like day and night. We saw, policy rates also come down. And then the economic environment, has been very, very stable. I know it's a short period, but, a win is a win. And we have to celebrate, our wins when we get them. The environment was really stable last year. We also saw the positive debt restructuring under the IMF support. And so a lot of things worked out really well for our Ghanaian economy. And now going forward, so these are some of the, charts that kind of corroborate, what I just talked about. So talking about, Q3 GDP numbers, the biggest contributing sectors were the agri sector and also services. And the best performing sectors, agri services and then also ICT tech. Underperformers were manufacturing and industrials, oil and gas, and mining. The outlook is very positive. So we think that, this year, 2026, we're likely to see a stable environment like we saw last year. This is the currency, appreciation we talked about. And so going forward, our outlook for the Ghanaian economy, the areas that we think the opportunities are, and this is, lumping together both the public and the private markets, because obviously our public market is not that deep. But where we see the opportunities going forward continue to be agriculture and aquaculture. Agro-processing is a huge, space that we see a lot of investments going into. ICT and tech, is another sector that we like. The services sector continues to be, a powerhouse. Financial services, we just had, First Atlantic list, last year. Hope to see more such listings, in the coming years. Manufacturing and industrials and infrastructure development. So the big push agenda is going to focus on developing infrastructure in the country. And obviously manufacturing, has also been talked about. One of the things that we keep, talking about is we are in a very strong position to industrialize our economy. We've had, one of the best years as a nation, the strongest performing currency, in the world for last year. What can we do with that, that strength? This is the time to use this strong position to actually diversify our economy, because stabilizing our currency with, pumping dollars into the economy, I don't know how sustainable it is. However, if we look long term and we actually are able to put in place policies that are going to help reduce our dependence on, importation and, foreign goods, that's a sustainable way to support our currency. So those are our thoughts on the Ghanaian economy, and I know our panel is going to do, justice, into the nitty-gritties as far as the Ghanaian economy goes. And then I wanted to talk about, so what are some of the macro risks, coming into this year? And so we know we had a very stable environment last year, everything looking good. However, there is the possibility of, debt and fiscal pressures. So there's, they talk about, going to the capital markets to borrow to fund some of these infrastructure developments. Now, if those, funding are not directed into the right, places and actually in the real economy, that could lead to inflation. And some of the gains that we had last year could be erased. It could also crowd out private, markets. I mean, rates have come down. There's an opportunity for private, operators to also go and borrow to expand. But if the government is going to, borrow huge sums of money to fund infrastructure development, that could crowd out private markets. It's something to be aware of, we also continue to have very, very high unemployment, and that is not good for the economy long term. The more we get, youth into the workforce, long term it helps, boost spending, and then it also helps as far as contributing to the pension industry, contributing to SNIT to fund the current retirees that are going to be withdrawing from these funds. I know a lot of companies have like chunks of retirees withdrawing in this current cycle, and that is going to be a major dent in the assets that have been accumulated to invest. And so until we have a lot of employment opportunities for the youth, in order to come into the workforce to boost contributions into these funding sources, it will be hard to sustain some of the investment opportunities that we want to embark on as far as infrastructure development goes. And I've talked about industrializing our economy. We currently are too reliant on external markets. Our country is import-oriented. Like everything, most of the things that we consume here are imported. You drive around the city, and in front of almost every household has a store. How many of those stores sell locally made products? I mean, it's amazing. Everybody is importing, and it's not sustainable. And so we need to be able to reduce that dependence on the global, on the foreign markets for everything that we consume in our economy. And so that continues to be a risk, long-term risk. We also have inadequate energy supply. I know we're not having as much, doomsaw as we had some years ago, but we've been experiencing, power outages, quite frequently. Meanwhile, energy bills are always going through the roof. There's talk about increasing the tariffs, going forward. Now, how do we industrialize if we don't have enough, power to support these industries? And so that is another major risk that needs to be solved. And then I've talked about how sustainable FX management is. So pumping, billions of dollars is good, but it's not sustainable. So those are some of the risks, macro risks, that we need to be aware of, coming into this year. And I hope this was helpful. Thank you for your audience.
We can do that again for him. Great presentation. So we get the opportunity to ask 3 questions okay. James has his hand up for the first one. Can I have the 2 other people? Okay, I'll come to you. James.
Right. Thank you very much, Peter. I think at the tail end, something struck me, and I don't know if that I should think that is something I should lay my hopes on. I mean, looking at, or you mentioning the outflows in terms of the pension funds, and you said that we need to encourage or create the avenue for younger people to be able to enter into the workforce so that the inflows can fund some of the outflows. And I'm thinking, is that also sustainable, right? Because if the pension funds cannot create value, and then we need people to contribute for you to pay out, how reasonable is that? How sustainable is that? I think that's just my question.
Okay. So thank you for the question. So there's two sides, to that question. And I understand what you're talking about, value creation for the pension industry. So the pension industry, basically, our duty, right, is to be able to invest pension assets for the benefit of the beneficiaries, so that when you contribute and it's time to retire, hopefully whatever you put in will grow enough to fund your retirement. So that is one aspect. That's a duty of the pension industry. Now, if the pool that is being, so in retirement, right, you are in a spend mode, okay? And so there's no income coming in, right? And so you take an average life cycle of, of any worker. You start working and you're in accumulating phase. So you just, work, save. You don't spend because there's money coming in. Now, when you get to retirement, you start drawing down. And so for the individual, I mean, you can, have anything wrong with them. They've done what they're supposed to do. They've done the right things, and so they are supposed to be spending to enjoy their retirement. But as the industry as a whole, those funds are being spent down. Does that mean that, something needs to replace the funds that are being spent in order to continue to spur economic activity? Now, if you have a huge unemployment, okay, people not working, first of all, it's not good for the economy in general, because those are talents that are just being wasted. Those are not being productive to help the economic activity. And they are also dependent on other, sources of other means to survive. So it's a lose-lose-lose situation, So it's not just for the benefit of the pension company to get those assets to invest, but it's good for the economy in general to get more funds. If we're trying to get, so the biggest beneficiary of the pension funds, is currently the government, right? Majority of the pension assets are put into government securities. What is the government doing with those, assets? They are also investing in other parts of the country. So there's multiple, aspects to the pension industry and what role they play. But to sustain economic activity, high unemployment is not going to do it. We need to create jobs. We need to create employment. We need a country is a going concern. And so when it's not being fed with both employment and also resources and funds, it's going to get to a point where economic activity is going to cease. And so that's the way I look at it. I hope that answers your question. Okay.
Okay.
My name is Frank Tevia. Somewhere in your presentation, I saw the effect of cryptocurrencies, but you never spoke about it. Now, given that the whole world basically is moving towards a new railings in terms of financial infrastructure, okay? Ghana recently passed the Virtual Asset Services Providers Bill, okay? And what this means is that you've got national laws, but the crypto assets are borderless, okay? Means that they're going to have a much bigger effect on our economy than before, okay? What do you think, this situation will have, okay? Because you mentioned something like, okay, when America sneezes, the rest of us, we catch a cold, which is true. And America passed the Genius Act for stablecoins. They are working on the market clarity, laws. Europe is working on MiCA. The world will change, and these are going to have great impact on our distant economy. What do you think this will have on the predictions that you've actually made, going forward? Okay.
So, thank you for the question. As far as crypto as an asset class, and I believe it's here to stay, the adoption rate is going to be slow, especially in the developing world. But I believe that it's the future. Blockchain technology is going to make transactions really, really easy going forward. However, currently, crypto is more of a speculation than a real asset class, because there's no cash flow. You cannot really value cryptocurrency at this point, and so people use it as a store of value. So most portfolios that will have crypto, will be a small portion to augment, the other asset classes that they have, just for diversification purposes. But to run cash flow analysis or scenario of cryptocurrency, it's almost impossible. And that's why it's hard to talk about. So, I believe, having a little bit of crypto, nothing wrong with that, but you cannot really value it. You're buying crypto based on expectations that the price will go up, but you cannot predict where it's going to be at. And that's why I don't talk about crypto very often. I can value other asset classes using cash flow analysis, better. And so that's not, my strength, in the crypto space, but I don't have anything wrong with it.
Okay. Do we have a third? Okay. Nana.
Thank you, Peter. Maybe for you or the panelists. So I did a quick computation of the Buffett indicator on a market. It's around 13%.
Of the Ghanaian
stock market, yeah.
Okay.
Yeah, about 13%, right? And then I also compared our average, PE to what you showed us. About SAP, 7. Yet, last week, I got a beating from a trustee. Now you're my boss, so for buying, an equity at about, 6, 0.3 times, P ratio. We got, some serious, questions to answer. So what is your view about the market, especially the Ghana Stock Exchange, going, forward? Do you think, we are overly obsessed, right, about price? And because we are so obsessed about price, the market is not really, valuing at the right, levels. Thank you.
Thank you for the question, Anna. And then I just want you to know you're still my boss, because I work for you. So it's hard to make that comparison between the U.S. markets and the Ghanaian markets. First of all, the U.S. market is very, very deep. There's a lot of trading algorithms. There's a lot of machines making a lot of decisions. It's more efficient, and so it's usually much harder to beat the markets over there than over here. What I would say with my little knowledge of the Ghanaian market is how thinly it's traded. It really offers a lot of opportunities for patient investors, and so I've spoken to portfolio managers and ordinary investors who applied some of the metrics from the U.S. market to local, stocks, and just held it, cut out all the noise, and the price volatility, held it for 2 to 3 years, and they saw huge returns. And so I don't know the specifics for the particular stock you're talking about and why you got a beating, but I believe that if you use the right fundamentals based on obviously, valuation methodology varies for various sectors, but being such a professional, I know I believe that you use the right valuation methodology. If you apply the way it's supposed to be done, and you are patient, trying to time the market and buying and selling like people trade, day trading, I believe that patience will pay off. But I believe that a local economy, local stock market has a lot of value that is not appreciated. One of the biggest, factors is investor education. People, a lot of people expect everything to go up all the time. And so we don't have a lot of patient investors that will ride out, some of these market volatilities. And that's one of the detractions, in our local economy. We need to do a better job of educating investors. People are used to government bonds because they can see, income coming every time, every 6 months they're getting something in. But having the patience to hold the security for 5, 10 years, long term, and see it play out is something that our local economy is not used to. And that's something that we as a society, I believe we can work on educating the market. So that's what I would say.
Thank you so much. Thanks for your questions. And thanks to our forecast speaker, Mr. Peter Bewa, CFA. Thank you so much. Okay. So I mentioned earlier on that we have sponsoring today's event, we have IC Securities, or the IC Group, and we also have Data Bank Group. Please put your hands together for our sponsors once again. We talk about AI, and we know that to be artificial intelligence. Data Bank also calls that automated investing, and there's a way that they ensure that their customers are able to automate their investments and have inflows coming in consistently without their own intervention. In the Data Bank Group, they have the diverse array of products for you. There's a Data Bank brokerage, Data Bank asset management, there's a pensions team led by my good friend Jabez over here, and they do well to make sure that they offer the best in services for you. Our other sponsor, which is the IC Group, also have a myriad of services that they offer within the investment space. These days, there's that very golden product that they put out there, which is the IC Wealth application, which enables you to invest from the comfort of your homes, your offices, whichever part of the world you find yourself. They also have the IC Securities, which offers the brokerage services, and the IC Asset Management. So these are two giants within our investment space that you can always rely on. We'll take a message from our partner, Stanchart Group. The media team will help with that. A message from Standard Chartered Bank. Chartered Bank. Okay. Ladies and gentlemen, up next we would have a panel session as a team of well-seasoned investment professionals who will be discussing the theme from restructuring to resurgence, identifying winning asset classes and portfolio strategies for sustainable wealth creation in the light of stable currency and declining interest rates. To moderate this session, we have one mind that I admire a lot. Always great listening to her when she leads any session or any webinar on investments and outlook. She currently works as the manager corporate advisory with Merban Capital Limited. Ladies and gentlemen, please put your hands together for Na Louisa Nelson, CFA. First, going up on the panel as panelists, we have the Vice President of the CFA Society Ghana and Chief Investment Officer, Black Star Group. I mentioned that he gave us some great insights a few years ago and is back as a panelist this year. Please put your hands together for Kwame J. Boateng, CFA. Up next, we have a woman I have lots and lots of respect for. She currently works as the Associate Director and Head of Databank Asset Management Services Limited. Ladies and gentlemen, give it up for Debbie. It's Deborah Amakote, CFA. The next one is a voice you are probably very familiar with. He's on radio like every other day, right? He works as the manager of macroeconomic research, investor relations, and ESG for GCB Bank Group. Please put your hands together for Courage Kwesi Boti. Over the next 40 minutes, they will take us through a discussion after which we would have some questions for them. Now, over to you. Please put your hands together for them once again.
Hello. Good evening, everyone. It's great to see old faces, some new, and hopefully some to be friends later on in the evening. It was some very good food. I have very fantastic people with me. AJ used to be my former boss. We do have the same team though, but I cannot mention it right now because we are not doing as well as you would expect us to. So, but we have a few things in common. Debbie, by the way, I heard something very interesting about you. I don't know whether we have a time for you to display it or not, but even though she's an associate director of, manages billions and billions, I heard she can really dance. So I don't know whether it's nice to see that you are a CFA charter holder and you can dance. So Deborah Amakote, CFA, chief dancer. Do you get it? But Courage I know from another angle. So Courage sings. So we have a dancer and we have a singer. What do you think we should do? I think Courage can give us one line. Debbie can give us one move. So Courage, you can pick the mic. I'm sure Debbie's heart is racing, but our economy has had such a fantastic time for 2025. We didn't think it could happen, but it has happened. And we want to just delve a bit into just really understanding what the winning asset class is going forward and how we can get strategies in order to meet those very good yields that everybody is looking for. So I will start with our chief singer for the evening. So Courage, we just had I'm saying we like I was part. They just had the MPC meeting. The governor did mention that, well, there's a lot of macro sustainability. Inflation has been within the band, and they expect that for the next 6 months is going to be in the 8+ or -2 range. and then they are looking to consolidate gains. In fact, before or during the whole sit-in, they were anticipating 100 to 150 bips, but then they did a 250 bips, so they are really taking a dovish stance. So now we are from 18 to 15.5. Do you think that we've reached the floor of interest rates? Or do you think that it will go even further because the government is looking to come into the bond market this year? Do you think that even though we are in the 11 to 13% range, we can even go to single digits?
Good question. Good evening, CFA Society, and thank you for the opportunity to be here. I get to meet a few old bosses, a few old friends, and I see a lot of you in the audience. I'm looking forward to this. Back to the question, can interest rate go any lower? I don't think so. And the reason is this. BOG, understandably, is being cautious with the policy rate approach as a way of, one, not distorting the market, and then bringing, I think, a sense of predictability in the whole situation. We've had inflation spiral to where it got to. The correction at some point has been sticky, and the reasons I believe we all know. The cyclicality of the decline in inflation and some of the extraordinary measures that were carried out that led to the decline we've seen from, I think, 23.8 to today, I think 5.4%, has been extraordinary, and I can delve into those. You look at it from the monetary policy side of things, it took very mammoth sterilization of liquidity in the economy to deliver that kind of result. That will come at a heavy policy cost to the central bank, and we are yet to see their numbers. So the question then is, the central bank that has posted losses in the last 3 or so years, and will likely post another this year. I'm not a prophet of doom, but from the indicators and all that, how long will they continue posting such loss at the expense of heavy sterilization? And today, they are operational because they are a state agency, not profit making, and they are policy solvent. But for that, it would have been a very different story. So the question is, for the health sustainability of Bank of Ghana itself, how much more intervention can be done to sustain the level of deceleration in inflation? Number two, the fiscal side of the equation had to also do some heavy lifting last year. The very first class act of Atu Forsen was to say that some 68+ billion in payables, some of which have been validated for payment. So some of them, a chunk of them were valid claims, had to be suspended and classified as arrears. Now that will be paid over a 4-year cycle. And that expenditure burden avoided alone was a big part of why inflation is what it is. And of course, in the first year of a government, the fiscal projects, the heavy liftings, the infrastructure projects that are heavy on the budget were not carried out as much, and we saw budget utilization for most of the expenditure lines that they did not, or they were quite short of the target. And despite revenue falling short quite significantly, expenditure containment was even stronger, and those were some of the reasons we saw the kind of inflation. Last year also, we had the benefit of good rainfall, good weather, which meant bumper harvest, and at some point we're talking of food glut on the market. So you saw food inflation component, which was otherwise sticky and had a heavy weight, which was holding inflation at the 23 levels in 2024, kind of reduced. Today we're talking just around 5.8 and all that. If you look at the totality of these factors, some of them are cyclical, some of them are extraordinary effects that I think in the normal schemes of things cannot be sustained for so long. And so if you look at it along those lines and the market reading into these, I feel that we may not be as bullish about inflation staying around 5.4. I don't think even the central bank expects that. I think even unfavorable base drift in the next few prints could bring inflation towards the 8% levels again. And that is what the Bank of Ghana says they expect it within that band by mid-year. So if you look at those kind of dynamics, I think interest rate to stay around the levels we see them now, nudging up slightly, but not so much in the next 3-4 months. The government have about 64 billion or so in deficit financing to do this year, slightly higher than what it did last year. And so depending on the borrowing pressure on the market and whether they can stay as disciplined as they were last year, all of those who have a say in where interest rates will move to. So on that score, I do not think interest rates could fall any further than they are now. At best, they stay around the current levels, and then we'll monitor, the market will monitor, I believe, what is going to be the fiscal posturing in the next few months, what is going to be the dynamics around the other drivers of inflation in the next few months. Of course, it appears, and I know we may talk about exchange rate, but it appears the exchange rate handle is also at the moment held, but what is holding it, we all know, and the question becomes if there is an unfavorable change, all of that, those dynamics. And that is why I think the central bank wants to be cautious around rate cut, and they won't bring it down as sharp as maybe people want to stimulate the real sector. But with all of these inside, I think the market, yourselves are wise enough and have run your numbers and all that, and I don't think there is appetite for much lower rates than we see them today. And the question about new bond issuances and all that, what rates they'll come out, what prices they'll come out, I think those are conversations that I believe the central bank will be, the ministry will be considering together with the advisors, and will find a price point that can lure you into the market. I don't think an 8 to 9% issuance today will be quite attractive for us sitting here. So on all of these dynamics, I think that rates may not go any lower. They might be around the current levels as we see them. Thank you.
Sure. Thank you. That's a lot to think about. But do you have a number?
Well, my forecast, and those forecast numbers are run in November. I think I place interest rate around between 11.5, 13.5 for the year. I don't have reason to change that yet. Thank you.
Sure. So you did speak about currency, and maybe we should touch that before I come to Debbie. So we had a great year last year. Everybody was excited. Well, some people were excited. Let me just put it in. No, because if you had your investment in dollar, you wouldn't be excited. But if you were like some people and you were waiting to buy the dollar, I'm very sure that you'll be very much excited. So yes, so mix a blend of excitement throughout the country. But the question is, did you think that it was a correction? Because over the period, there must have been some speculation here and there. Do you think that it was because it was quite drastic? Do you think that it was a correction? And do you think that the cedi has bottomed? Is the question that the only way is up? And if the only way is up, please tell us so that we will know. Well, I'm asking for a friend.
Yeah.
So that we'll know what to do.
One day I spoke on radio, giving view about exchange rate. And after that, someone very prominent at the Bank of Ghana today gave me a call. I don't know where he got my number. He was like, Harry, I listen to you all the time, and you are mostly spot on. My only advice to you is that for exchange rate, try to just give direction and not put a figure to it, because a lot of the dynamics you cannot predict. And then I thought that was a good answer, a good feedback. So since then, I have shied away from putting a number to exchange rate. But that said, the exchange rate, I think, is a correction. I know there is a huge debate around this, whether the exchange rate is overvalued or undervalued in the first instance. I look back to prior to the crisis, 2020, even within COVID 2021, we were looking at around 6 cedi or so, 6.2, 6.3 to $1. And I remember when the breaking the 8 conversation started, it wasn't long and then the cedi broke the 8. So it became like the cedi is breaking the 8 and all that. But we know the triggers, right? The warning bells have been there. Various IMF reports, Article 4 reviews, and other reports suggest that we were at high risk of debt distress. We've seen the debt sustainability analysis and all that. And I remember in the 2021 IMF report, Article 4 review, the exact comment was that unless we are taking some macro-prudential interventions to reverse the trend, we are at a high risk of debt distress. And so when the 2022 budget came, and it appeared that we threw all caution to the wind and we were going on the expenditure spree as usual, I think that spooked the market. It triggered the reversals, and those were the reasons our reserve got depleted almost threadbare. And in such an instance, you were at the risk of default on the Eurobond market, and so we had to, I think towards December, suspend all external debt service and all that. The interventions thereafter have been building reserve quite aggressively. Long story short, the gold for reserve, and the variant of it came to be, and I think that policy has served us quite well. And I've been asking myself all this while, why did we not do this all these years? Maybe every crisis comes with opportunity. The story I'm trying to tell is that we have had to do some extraordinary interventions on the market to get the exchange rate to where it is. And if you look at a normal trend from, I think apart from 2014, where we saw about 32% or so annual depreciation in the cedi, from 2016 all the way to, I think, 2021, average depreciation annually has been around 8, almost 9% averagely. And so if you look at that normal trend, we shouldn't be getting to the 17, 16 cedi levels that we got to in I believe 2022, 2023 levels. And so on that score, and if you look at the fundamental drivers, apart from reserve getting depleted, which has been restored almost instantly, or at least after a few months we got it restored, I thought that the whole thing about debt restructuring and the bearish sentiment and all that held the market back for long. And for most of us here and other investors out there, they saw dollar investment at more viable under the circumstances. And so that kind of behavior, speculative behavior, undermined the cedi for a long time. Now, fast forward, fundamentals corrected, reserve built back, macro stability re-emerging, and we see today we're talking almost 6 months of import cover, and of course all the interventions around it. Naturally, there will be a correction. And if the past managers of the economy were the problems and the macro distortion were the problem, those things are correcting and we could see the evidence of it. So I do not see why there shouldn't be a correction. And so whatever happened is a correction. I think my projection start of year was that we could, and I didn't tell anyone this, it was just in my report internally. My projection was that we could do about 13.8 by end of year, looking at the budget of the new government and all the interventions and all that. We ended up on the interbank market just around the 11, I mean 10 point, I think 8 or so thereabouts. And for me, that was broadly aligned because my subsequent adjustment along the year placed it at 12, and we did just about 11. And if you look at government's budget for this year, it is not assuming appreciation. I think the projections, if you deduce from the numbers, suggest they are working with an exchange rate of 13.5, thereabout to $1. And so if you look at all of these, I think the worst part is over. I think the cedi has found some level of stability, and there is fundamental support for it on the current account side, on the trade side, and of course on other front, fiscal side, all of that. But the caveat or the caution is this: a lot of it is, call it hot air, quote unquote, and I'll explain that. Today, our export receipt is about 31 billion, extraordinary growth, but a large part of that is gold. About 67, almost 70% of our export earnings is from gold. And gold today is about 5,100 or so, which is again unusual. So if you realize the central bank liquidated about half of its gold holdings, I believe the consideration is that, of course, they've given an official reason, but I think the consideration also may be that
We are at near a peak for gold price, and they are, if you look at the valuation, they were not using the market price, they were using a price way lower than the market price. So it's time to liquidate at current market price. And remember, some of these golds were bought 1,500, 1,700 per ounce and all that. So it was a good time to take some profit, realize the liquidity, which is what bumped up the reserve, and then they can build again. I think that is the strategy. And so if gold price recedes, the initial fear that we had about valuation of the gold stock and affecting reserve, they are trying to deal with it by liquidating. So that has helped a bit. But then the whole bit about why our current account balance today is about 8.1% of GDP surplus, and all of that is driven by gold, which is supportive of FX. How long will this continue? Cocoa, we saw around 10,000, 11,000. Today, it's receding. Gold, I mean, if Trump gets some sanity, quote unquote, and then the geopolitical threats begin to recede a bit, I think that gold, the safe haven appeal, will recede a bit, and the current account surplus that is so much serving currency well would also begin to dissipate a bit. And so the underlying factors of marginal depreciation may continue, but not to the levels that we have seen in 2022, 2023. So simple answer, I think the CD is kind of bottomed out. There may be marginal depreciation going forward. I don't expect further appreciation in the year ahead. Thank you.
Very, very simple answer. So, courage. I think we can clap for the CD. It's doing well. So Courage said, you mentioned like 13.8. It was Courage who said it. So that if they are calling, they would know who to call. But Debbie, thank you, Courage, for that. Debbie, so they said they want a winning asset class. I'm speaking on their behalf. So the simple question is that with interest rates where they are now, people having to start doing active portfolio management, what do you think are the best winning asset classes in this market cycle? And hopefully to look at Ghana and then Africa. We hardly look at Africa in terms of that context. And well, Peter did a lot in the global context. So if you can look at Ghana, Africa, and probably the global context, that will help us.
Good evening, and thank you, Na. I will want to do some moves. That's just by the way. So, Courage have mentioned a lot. Peter also did capture a few things about the markets, the global markets, Africa and then Ghana. We have seen, let me just narrow down to Ghana for now, with a stable currency, inflation declining, and then interest rates peaking where they are. We have to make a mental shift from where we are coming from. The crisis regime where asset managers were focusing on cash, and then currency hedging is right behind us, and we need to start thinking about assets that are policy aligned, and then that's our interest or income earning, and those that are liquidity sustainable. And so if you look at these three parameters that I've mentioned, when the CEO for the GSC was talking, she did mention a few assets. And Peter also mentioned infrastructure bond, green bond. One of the items or parameters I just mentioned is income earning. And so even if, and the governments have mentioned in their budgets about coming up with these bonds, infrastructure bond, green bonds, but as part of our call as professionals, I believe that we should be very much in the structuring of these bonds where we will make sure that these are targeted at particular revenues that will pay us back. And that way we are more or less, we've taken ourselves out of any possible restructuring that could come up. But that is just, so if you're looking at the asset classes broadly, I'll first touch on the fixed income. We can't go away. We can't run away from it. And based on our MPRA guidelines that we have, we need to have an anchor in terms of our strategy. And so fixed income from high quality grade in corporate bonds government could be part of it, and it should be part of it, because at this point, that is what is giving us positive return. And it will give us positive risk-adjusted return for some time until there is another restructuring. Hopefully not. But for us to diversify that particular asset class, and then we need to look at the high-quality corporate bonds. So if you have that as your anchor, where you have good quality ones listed on the exchange and even unlisted ones, in recent times, I think the NPR did give a directive that we should hold back on the unlisted ones until they are fine with a few things to come back to us. So for us to focus on the listed ones for now. When you move away from the fixed income, it's been on everybody's lips about diversification. And we've been saying that over and over and over again. But what does that mean in these times? So in Ghana, our options are very few. And so then you have to then move into the frontier markets. I think that is not where most of us play. We have very few players who are focusing on frontier market, but there are very good opportunities out there. You just need to make sure that you are matching your currencies properly for you to be able to generate positive return for your investors. Globally, equities, Peter did mention a few sectors that could drive growth in these times that we are in. And whether we like it or not, whatever happens in the US translates here that we also suffer from whatever goes on. So as I've mentioned, the fixed income as the anchor, and then you try to lace it up with these different asset classes. Gold has become, whether we like it or not again, a policy-driven asset class because of the gold board, and then it has become the main tool that is being used now for currency management and then managing our reserve. And so once you have some exposure to gold, now we have the new gold listed. So that is something that especially pension fund managers could look at. As private world clients can have direct exposure to the gold asset class.
Thank you, Debbie. It looks like you were drawing a line with it's like you have matched your strategy and you're like, you don't want them to hear what you wanted to say, but thank you for that submission, and probably we are pressed for time, so I may come back to you on that, but I know AJ has been boiling.
No, sorry.
Because I have a very interesting question for you. It's a bit controversial, though. But I mean, with all the asset classes that Debbie has mentioned, and just looking at the asset classes that you work with and what Peter mentioned, what do you think has been the bottlenecks to implement those strategies? And what do you think is the way forward with that? He's thinking.
Okay. Good evening, everybody. Okay, so I think there's not a simple sort of answer to that question. You have to look at from clients' perspective, from market operators' perspective, and then from regulators' perspective, right? And in each of the cases, you could pinpoint examples where there's been bottlenecks, right? Okay, so let's start with the market operators. That's where we all operate from, okay? We would have to admit that we've done a terrible job at product innovation, right? Gold is mined in Ghana here. It's perhaps the only investment grade asset we have in the country. But we had to wait for Absa in South Africa to introduce the ETF here, right? So I looked at some numbers, and if since we introduced tier 2, tier 3, we were allowed to put maybe say 10% of the assets in gold. In the last 15 years, it would have gone up around
28 times, right? That is something is right in our doorsteps. We just haven't done it. And then if you, in the same sort of line of work, we've also not done a good job at investor education from market operators' point of view. And that is often not also I mean, I've been in the arena, so I know some of these things. Sometimes it's not the market operator's fault because you're dealing with clientele base whose understanding is not there. So one of the conversations I was having with Abuna is that actually the CFA society need to partner with the GSE and then train some of the social media influencers in terms of, if something has gone up, doesn't mean it's going to keep going up forever, right? So we need that education. So from market operators' point of view, you have to look at product innovation, investor education, and just, just final example on that side is there was a scenario where the whole mark-to-market directive that came into is a brilliant strategy or brilliant idea. It's practiced everywhere else, right? But there were very affluent sort of market players who thought it wasn't the best idea, right? And my view towards that is that if the truth will kill them, then let them die, right? Because everyone else around the world understands that securities is not just one way, right? We have to get Ghanaians to understand that it's like investment can go up and down, and when we say that, we're not just saying it for saying the sake, right? So that's one area. So then you can look at it from the client's perspective. Again, it's more on the education side. So we need to do more work. And obviously, I'm going to say something which is not going to be popular. There are scenarios where people who are very, very well educated, you engage them, and you expect them to comprehend some of these things much better, right? In the same way that, in our side, so Peter would know some of these things, or Mr. Terry is here. There are certain concepts which make sense to like very young people outside, but we struggle to really comprehend when it relates to investing. So, and the answer that I came to was proximity, right? So, outside, when you're born, as soon as you're crescent, the money you get is put in the S&P 500 or like a handful of stocks. So from earlier on, you're used to stock going up and down, right? But like that concept sometimes it's not well understood here. So maybe, I don't know, it's something to do with education. We perhaps need to include financial education, how these things sort of behave. So that's the client side. And then you have the regulator side, right? There's room for improvement, let me just say. Right? Yeah, let me just say, so some of my regulators are here. Why do I say that? Why do I say that? So, in a world that's just changing so quickly, you can't have a situation where if you need something approved, some of your main regulators the board of directors only sit 4 times a year, once a quarter. When the world is changing and you need to react quite quickly. So we need to have a faster sort of response time. Mr. Dewe said something that's very important, and actually, I think the question could have been sort of elaborated a bit on. In the next sort of 10 years, almost all assets might be tokenized, right? You need to have regulators who are thinking in that lens, right? Otherwise, we'll be left behind. So I think we've made a great step in terms of introducing the virtual asset, but that needs to be surrounded by more sort of proactive ways of dealing with that. You can't have a virtual asset where only the decision making on that happens once every quarter. No, we have to do things in a much better space. And then on the same regulator space, in terms of, we could have done better in terms of asset class universe, right? So for the longest of time, our investment landscape has been constrained by what is here. Now, diversification, like we just needed to give a broader sort of asset class range for Ghanaians. I'll give a very good example. So there's no reason why Ghanaian pensions should not be holding Dangote Business Group, right? It literally, is one of the most successful businesses on the continent. And if the market is open to maybe say Ghana, Nigeria, maybe some of the other English-speaking countries, more money is likely going to flow into Ghana than the other way around, right? Because one, our currency is a little bit more stronger. They're looking for also diversification on their side, but in return, we might also sort of get some pockets of opportunities that we can sort of also use to diversify. So in terms of that, there isn't one single answer, but I think collectively we have to look at the regulated space, look for ways that we can improve things. Market operators, we need to do more. But this is one area where we have a bit of control, and then we need to engage with our regulators to improve clients and Ghanaians' education to sort of better improve our general understanding.
Sure, thank you, AJ. I'm very sure when he said that when you're Christian, they put the money in the S&P. Now you have started calculating. You want Trump account. I'm sure by now you would have had a lot of money. But yeah, we have, I think, room for about 2 questions. If you do have a question before we close out the panel. There's a hand at the back. There are 2 hands at the back.
Hi, my name is Belinda. I really appreciate the comment that you made about exposure and people being comfortable investing. So I recently relocated back to Ghana, and I'm trying to invest in the Ghana Stock Exchange. I'm trying to find out information, what would liquidity. I know about it. Oh, sorry.
1, 2.
What would liquidity look like to get my money out and all of that stuff? And there's just limited information. So it makes me uncomfortable as a charter holder, right? To even invest when I understand this. So I guess my question to either one, and Courage, it looks like you've been out and talking to people, what is the main roadblock? What makes it uncomfortable for people to invest? What is is it cultural? Are we just risk-averse people? What is really the mindset behind people feeling comfortable enough to invest, ask questions? What would you say, what are we missing as a country, I guess?
People to answer this question than me. Just a comment, and I'll make an example of my bank, GCB, because I'm the investor relations manager. Truth is, you look at GCB stock, 51. In fact, nearly 70% of it is held by people who have no intention of trading it, right? And that's strategic. And then there is also a chunk of retail investors who, at the time they were buying the shares, the message was that this is a national asset that is being divested, so go and buy. And these are all these public sector workers then who put their hard-earned monies in there. They have no intention of selling. So you have the tradable book, what you call free float, looking like just about 25 or so % thereabout. And so in such an instance, you cannot have so much liquidity in the stock. And I think that story applies to a number of other stocks in the market. You look at MTN, which trades the most. The turnover for MTN is very low.
in any given year, even if they trade so much volume. And it's for same reasons. A lot of people who buy these things are holding on their books that there's no intention to trade immediately. And so that knowledge or education that you could either be active or passive strategically for value is not sold onto most investors yet. They're unsophisticated investors yet. And so if they are buying for life. And that is why I think there is not so much trade happening on the market. But of course, they are better placed to respond.
Yeah, so as cultural in terms of mentality when it comes to investments, Ghanaians are used to things that go up and never come down. And so we are very comfortable with fixed income. And now that the bar is even low on treasury bills, any investor or any individual who wants to just do the treasury bills on quarterly basis, I get my money or I get some coupons, something to hold on to. Once you have equity markets as we have it, and Abna did mention, our markets are so shallow. And so you have most of the investments or most of the companies' holdings being in the hands of institutional investors. There is no much activity going on the market. And so as an individual, if you are holding 10 shares and you want to dispose that off, that obviously is going to be difficult for you. And so a retail investor will feel very comfortable going to the fixed income market as compared to going to the equity market. That's why you are finding that you are not having, but if you need information on the market, I think there is a lot of information on the Ghana Stock Exchange website that you could pick up from in terms of even the top 20 shareholders and all that is on the market, is information on the website that you could explore. And that should tell you whether there is liquidity in a particular stock. So if you find a stock like MTN, you have a lot of retail investors in there. And so there is a lot of activities ongoing in MTN. A stock like CAL used to be very active, and so one of our cries was that it was too volatile, because every now and then you find a retail investor selling 10 shares, and that drops the market. You are a portfolio manager, you are holding 1 million shares, 10 shares will drop the market, and so it becomes unattractive for big portfolio managers like us. So that is the challenge that we have on the market. But I believe that we are all trying in one way or the other to do a lot of education. What we've tried to do more in the asset management side is to use the CIS, the collective investment schemes, to do a lot of education to encourage retail investors in particular to be interested in investing. So I believe that with time, we'll get there.
I would just add something small to access to information. Maybe perhaps the avenue that you're sort of looking at, because I do know that a fair bit of information just gets published, including ourselves. So Black Star Group, I know DataBank publish a lot of information. IC also releases, in fact, in the case of the firm that I work with, Black Star Group, every day we release like what has been the most traded security. So if you follow us on LinkedIn, that information just get released like daily. But I think the other sort of institution, DataBank, IC, also regularly sort of release information. I think on the websites of some of these companies, they will have that information. This is my 5th year. The question of why people are hesitant, I think trust is like a big deal. A lot of Ghanaians have lost money from some sort of investment that they did. Some of them ended up being like a Ponzi scheme and other things. So if you now compound that with the fact that the domestic debt exchange, meant that like other people lost money. So trust is like a real problem here. So I think that is a contributing factor too.
The second question, yeah.
Okay, I'm happy and I'm really blessed to come in your midst here, because I feel like I'm lost, but I feel very special right now because I was expecting to see most students being here, because I feel like whatever you are teaching right now should be impacted. And we are talking about education, like implementing. You talked about education, but I don't know how you are educating it. Like, how are you going about it? Because I've been in quizzes with stocks, but I really didn't understand anything. It was just chew and pull. So I actually was blessed to find a mentor who is like, I now understand the stocks and I'm understanding how it's going. But like, how are you able to also teach my friends out there, like implement it to them and help them to be young investors?
Okay, I'll give this one a go. Great question. I think it is something that collectively as an industry we need to have a better way of bringing the wider society on board, and hence why one of the things I said in the beginning was that we need CFA Society Ghana need to partner with the GSE, MPRA, like basically. If it's a curriculum that we need to design for schools, so that as you're going through your schooling years, like these are concepts that are part of your curriculum. We certainly need to partner with the influencers. I think we might be underestimating how profound their impact are on Ghanaians' ability to sort of invest. Some of them have over 300,000 followers, right? So I suggest we perhaps invite all of them. The CFA Society, in collaboration with our regulators, can organize some sort of a training program. I think that will go a long way. But credit to you for seeking a mentor, and just keep going. It's brilliant sort of way to approach life.
All right. So my name is Musa Hidar, and my question is, Courage, you talked about the Fed not being further dovish, in the sense that with the recent hearing that they gave, which the Fed cut, BOG cut about 25 basis points. So 250 basis points, sorry. So with that policy decision that they had, don't you think they were too quick in cutting it, in sort of maybe spreading it within the 4 calendar sitting that they have in a year, maybe 50-50 or something of that sort? My second question too is that with the CD, last year at some point you could see that the CD was trending downwards and almost hitting the 9 CD per dollar mark. But when the president came and he said what he said, you could see. Yeah, we realized, the CD, he said the CD will be 10 to 12 range, and that's really happened. And with that particular incident happening, do you think that particular trend will follow into this year, like the CD volatility being in that particular spectrum? Yeah, so that's my question.
Thank you. So, good question. So, in the crisis period, when inflation was 54%, what you call the real monetary policy rate was about 8-9%, and you need that level of tightness to rein in inflation. But no one desires very high policy rate. What it leads to is higher cost of borrowing for real sector players, and of course, even for government itself in financing its deficits and all that. What you also don't want to have is monetary policy being subservient to fiscal policy, and that you want to lower rates to try to ease the cost of funding for government and all that. So you need a balance that creates jobs. We are an economy with high unemployment rate. We are an economy that is begging for growth. We are an economy that doesn't produce much. And let me surprise you, out of our 31 billion export receipt, just about 3.6 billion is coming from everything industry has been doing in the name of manufacturing and all of those. The 80% is from gold, cocoa, oil. about 70% from gold, which is a non-inclusive sector. So if you want to create jobs for the youth, students that are coming, you need a market where interest rates are affordable. And in this phase we are, with the policy rate now where it is, and likely to go down in subsequent meetings and all that, what it does, the GRR will come down, lending rate for banks. And today what banks are thinking about is how they would survive in a low interest environment and all that. But that is good for real sector. So, and Bank of Ghana doesn't have to be aggressive in that the drivers of inflation are not completely tamed. And so you need to go cautiously on your approach to easing policy rate, finding that balance, and then standing ready to not distort the market, but also not be overly ahead of the curve and stuff like that. So I think the 250 is optimal, and I predicted between 250 basis point cut, and so I'm not surprised what they've done. I think when they go into March, they go into May, they would see better picture and then decide accordingly. Your second question as to whether exchange rate could correct further, as in appreciate further. I think I answered that earlier, right? I don't see further appreciation, largely stability around the levels. We've seen 4% depreciation in January. Largely Q1 tend to be seasonal, but we've also seen some interventions from the central bank that has been heavy in stabilizing the exchange rate, and I think that is going to continue. So yes, a sense of fair stability, and stability doesn't mean no movement at all. I think there will be some marginal depreciation this year by end of year. The budget itself is assuming 13.6 or so, or 7 thereabout. If you work the numbers, it could be lower than that, but it won't be further appreciation. I think it will be largely stability around the current levels. I don't know if I've answered you.
So Prince, so I think we're a bit pressed for time. So just one final question.
Thank you.
Yeah.
Yes, my name is Michael Owusu from EDC. Courage, I would want us to revisit the conversation around the gold reserves that declined from the 38 tons to the 18. You tried explaining it, and also the footnotes that they left in the summary of economic and financial data indicated that it had been turned into FX reserves. And you also tried explaining it as the expectations for gold peaking possibly at that 5,000 USD per that fine ounce. What I want to know is, how do we reconcile that with the global happenings? If we should take a cue from what happened at Davos, where Makani, with that inspiring speech, spoke about breaking away from the hegemons. For the first time, he visited China, and that was the last time we saw that was like 8 years ago. Just yesterday, Keir Starmer touched ground in China. A lot of people are looking to diversify, so there's even the sale of US treasuries. So how do we reconcile the decision that the central bank took in reducing the gold reserves and then the general global happenings that we are seeing? I just wanted a bit more view on that. And if I forget your name, but AJ, if you could also touch on that, I'd really be happy. Yeah.
Just to clarify my point, what I'm trying to say is that the Bank of Ghana gave an official reason for selling off part of the gold. The reason is rebalancing the portfolio, and it makes sense. What I'm saying is that another reason could be that, yes, you bought part of that gold around 1,500, 1,400, 1,700 and all that. And the general concern on the market has been that, is that sustainable? What if gold price decline? So for now, you value it on your book even below market, and whatever the valuation is a paper valuation, right? So by realizing it at today's market price, and if you bought at 1,400 and today you're talking 5,100 thereabout, there is value to be creamed, right? And that is what they did. And I don't fault them for that. And of course, they'll keep buying gold. The reason gold is surging, I think we all know. Geopolitics one, and the flight to value is not necessarily happening in the USD because of the Trump effect and all of those stuff. And so people find gold a safe haven to preserve value, and that is why a lot of it is going there. But it won't stay there forever, right? And so if you are liquidating today, you are creaming value. And remember, there has been a lot of talk about some 215 million loss on gold trading, which would account for some negatives in Bank of Ghana's books and all that. By trading this volume, you could largely be wiping out that 215 million loss that has been so much talked about in the media and all that. So it could be strategic, it could be anything. But I'm not by any means saying gold is at its peak. What I'm saying is that maybe they consider that where it is, it's at optimal price, it's approaching a peak, so let's cream value now. So we do not crystallize, or we crystallize the paper gain that we have been reporting. I think that is the whole conversation. I think I've forgotten your second question. Well, yes, it's a matter of strategy, and you look across the continent. Examples exist. You go to, say, Egypt. You go to Algeria. If you look at gold reserve as a total, as a percentage of their total reserve, I think largely they are operating in the region of 20-25% thereabout. Bank of Ghana's concern, which is the official reason they give, is that they went above what their peers are doing, so they need to normalize, right? So it's a matter of strategy. US have gold stock that is so huge. UK have same, that is so huge. If they've not found reason to liquidate it, and they already have a lot of liquid reserves, and then they are not at immediate risk now, they may not take that decision. So we are operating from different policy frameworks and motivations here. The reason for our gold for reserve is to build back reserve. And if the risk is a loss of value could lead to depletion, and we are nowhere near 10 months of import, 12 months of import like other countries who have and all that, then it makes sense to sell now when you have value. Of course, it's a judgment you have to make, or me make, that is gold near peak? Could they have waited? And they didn't sell at 5,100 anyways. They sold before that. And again, it's strategic. The month in which they sold it, I guess, and these are all my analysis. I mean, I'm not saying it from any official source. I am supposing that the timing is strategic to deal with that 15 million lost that was much talked about and all that. So if you have these this background, then it makes sense to do that kind of trade. Maybe the Bank of UK, the Bank of England, and the others do not have this kind of motivation. So look at it in that context. Thank you.
Okay, so I was scratching my head like for about 5 minutes when I saw that decision had been made, right? And here were my reasons why. Well, if that was such a brilliant strategy, we will see all other central banks trying to liquidate a bit. And yet you are in a world where everybody is aggressively accumulating like gold. You are not in a situation where you're under stress in terms of GIR perspective. And also, like, in a world where, the geopolitics, BRICS, you mentioned Marcani. I've been following it. I've been following the whole thing. It really did not make sense to me when I read that you had exchanged gold, which in the grand scheme of things looks like it might sort of continue appreciating, for paper money, like where everybody is trying to run away from, right? And gold is fairly liquid. If you need to sell it, you can. But it's closely linked with other things, which it really has baffled me in the sense that, for the first time, we were serious about building up our gold reserves. Any major country that has been able to sort of achieve currency stability, when you look at their balance sheet, often have a decent amount of gold reserves. So to have that in a space of that sort of time period, I thought really, really didn't make a lot of sense, because we built up our GR to a respectable level. Countries generally, we're able to sort of do things in a fairly sort of decent way. So for me, honestly, I think it might be suboptimal sort of decision there.
Just to add on to, so depending on the valuation model that the central bank is using, you have some countries that are marking to market, they are holding in gold. And then you have some countries that are holding it at amortized cost or at cost. When you are holding it at cost, then you are likely to just be adding on. If you look at Bank of Ghana, they seem to be marking to market, which will mean that as the prices are going up, the percentage holding, the ideal percentage holding in the reserve from coming from gold will be higher, and so they need to, what you will say, you need to book profits to bring it back to rebalance level. So I don't think it was a bad idea. We need to actually understand what their valuation methodology is to understand what exactly they are doing by selling down. And if the valuation methodology is indeed mark to market, and Carrie did mention that as of last year, November, they were holding it as 2,800. That was moved to 4,800 after the sale, and it's now reflecting 5,000, which should tell you that they are marking to markets. And so obviously, as the value is going up, they will need to book profits and then bring it back to the ideal level.
Thank you so much, ladies and gentlemen. This is how much time will allow us to have. We've heard Courage Boti, we've heard Deborah Amakote, Ajay Boateng, known as AJ, and I am Na Louisa Nelson, CFA. God bless you all. Hello, please, simple point of correction. Please, this is Deborah Ama Akote, CFA, and AJ Boateng, I was concerned about myself, but AJ Boateng, CFA. Thank you.
Let's hear it one more time for our panel. Great. So this to remind you that this is an event powered by the CFA Society Ghana, proudly sponsored by the Databank Group and IC Group with partnership from Standard Chartered Bank. The next part of this program is one I'm very excited about, is one where we get to celebrate the toil, the hard work, the many sleepless nights of gentlemen and ladies who embarked on this journey to attain that highly coveted credential, the CFA. Please put your hands together for these great people who will be celebrating this evening. So over the next couple of minutes, we'll be calling them forward to honor them specially. These are people who over the last calendar year have earned the CFA credential. But before we do that, we want to take a message from the CEO, the head of the CFA Institute. The media team would help us with the message.
Hello, everyone. I'm Marg Franklin, President and Chief Executive of CFA Institute. It is truly an honor to join you today via video as we celebrate a major milestone in your professional journey, the moment you officially become CFA charter holders. First, let me offer my sincere congratulations. You've accomplished something that very few in our industry can claim. Earning the CFA charter is a remarkable achievement, one that demands not just the technical knowledge, but commitment, integrity, and resilience. It reflects your determination to set yourself apart and your deliberate choice to hold yourself to the highest standards of professional excellence. As you well know, the CFA program is known for its rigor. It asks a lot of you, and it should, because what's at stake is not just your own personal advancement, but the trust that clients, firms, and society place in financial professionals. By earning this charter, you've signaled that you're ready to carry that responsibility. We welcome you into our global community of more than 200,000 charter holders around the world. You're joining professionals from 164 global markets, working across investment management, private equity, fintech, wealth management, risk, and beyond. Wherever you are in the world, whatever path you choose, this charter will continue to speak for you. It's your calling card. Today is a moment of celebration, but it's also a moment of transition from candidate to charter holder, from student to steward of our brand and reputation. And this does not mark the end of your learning journey. At CFA Institute, we know that lifelong learning remains essential. In a fast-evolving profession, one where artificial intelligence is transforming how we work, where sustainability is reshaping how we allocate capital, and where geopolitical and macroeconomic complexity are defining the investment landscape, standing still is simply not an option. And so we at CFA Institute continue to innovate to provide you with more learning options as you progress along your career path. We offer much more than the CFA program, be that from advanced learning certificates in private markets and climate risk to practical skills modules in Python, financial modeling, and ethics in action simulations. We are committed to being your partner in career-long development. You deserve a break now for sure, but at some point, I hope you will engage with us again on your learning journey, because no matter what stage of your career, success today means being willing to skill, reskill, and upskill. That's what distinguishes the best professionals, those who are not only technically competent, but also adaptable, curious, and principled lifelong learners. You've already proven that you can meet high expectations, but what will define you now is how you continue to grow and how you contribute to our profession and society. So this brings me to another point, community. You did not get here alone. I want to acknowledge the people behind your success, your families, your friends, your colleagues, and your mentors. Their encouragement and support, in ways large and small, helped you stay the course during long study sessions and challenging moments of self-doubt. Maybe they offered you a word of encouragement or a gentle pat on the back. We all need those signals. Be sure to thank the people around you who helped get you to this milestone. And I also want to recognize our incredible CFA societies around the world. These societies are the heart of our community, providing candidates and members with professional development, networking opportunities, mentorship, and a deep sense of local engagement. I encourage you to get involved with your local society as a member. It's one of the best ways to continue building your network and your knowledge. This remains one of the most valuable aspects of being a charter holder. You are never alone. You're part of a trusted global network, a community bound not only by a credential, but by a shared commitment to ethics, to excellence, and to making a positive difference in our industry and the world. I've been a charter holder for many years, and I can say without hesitation that the CFA program changed the course of my career. It gave me not only the technical foundation I needed, but the confidence to lead and a community in which to thrive. It opened doors, and even more importantly, it connected me to a mission. Because what we do matters. Finance, when practiced with purpose and professionalism, can be such a force for good. It enables retirement security. It funds innovation. It drives economic growth. And you, our newest charter holders, will be stewards of this work. As you take this next step, do so with pride. You've earned it. But also take it with purpose. The world needs financial professionals who can think long-term, act ethically, and serve with integrity. On behalf of all of us at CFA Institute, welcome to our community. We are so glad to have you with us. Congratulations again, and be well.
Okay, congratulations. So to help with the presentation of certificates to these newly minted charter holders, we'll begin with the president of our society, Jojo Kakrabanaman, CFA. Please put your hands together as he comes forward. Jojo is going to help present certificates to the first 5 to be mentioned. I'll read out abridged versions of the profiles for these gallant gentlemen and ladies, because trust me, these profiles are profiling. So I'm going to just give you a very abridged version of them and then mention the name. Put your hands together as they come forward. When they do come forward, they'll take the certificate, look to that camera, give us a nice smile, and then you applaud them as they take their seats. Can we do that? Please put your hands together for yourself even as we get this exercise done. Okay, so I'm taking the first one. He's an assistant manager in deal advisory at KPMG Ghana, where he leads engagements in valuation and financial modeling, mergers and acquisitions, capital raising and balance sheets restructuring, and infrastructure project finance. His work focuses on helping clients make informed, risk-aware decisions that drive value creation and long-term financial decisions. Ladies and gentlemen, please put your hands together as we welcome Ebenezer Boateng, CFA. Let's celebrate him. Thank you, Ebenezer. Congratulations. Our next person is an Associate Portfolio Manager at Bora Capital Advisors Limited. Ladies and gentlemen, please put your hands together for Jennifer Mensah Boateng, CFA. Congratulations, Jenny. Our next awardee is currently a research and portfolio analyst at Cal Asset Management, where he evaluates investment opportunities and contributes to the development of strategic investment plans. Ladies and gentlemen, please put your hands together for Sedinam Krufe, CFA. Up next, we have a gentleman who serves as an assistant manager in deal advisory at KPMG in Ghana, with experience spanning transaction advisory and corporate finance. Ladies and gentlemen, it gives me joy to introduce James Redu, CFA. You notice that he almost hugged Jojo, right? Yeah, I saw that too. Okay, so we have 4. Thank you very much, Jojo. Thank you. Yes, thank you. Please put your hands together for Jojo. Up next, we have the immediate past president. No, he's not now getting his charter. He got it a while ago. Of the CFA Society Ghana, Nana Wiafi-Boama. Please put your hands together for Nana as he comes forward. Okay. Our next awardee currently serves as an operations analyst at Cal Asset Management Company Limited, where he previously served as a research and portfolio analyst. Before joining Camco, he lectured at the Ghana Baptist University College, sharing his expertise with the next generation of professionals. I can tell you that he still continues to share knowledge. Ladies and gentlemen, please put your hands together for my friend Nicholas Muzoli, CFA. Congratulations, Nick. Awesome. Our next awardee is a seasoned investment management professional with extensive experience in multi-asset portfolio management, investment strategy, and macroeconomic research. He currently serves as acting chief investment officer at Cal Asset Management Limited. Please put your hands together for Joshua Derry Cheto, CFA. Congrats, Josh. Okay. Up next, we have this gentleman who is the managing partner of EAK and Associates, a firm of chartered accountants with close to 2 decades of professional experience spanning auditing, taxation, corporate finance, ESG compliance, and restructuring. Ladies and gentlemen, Emmanuel Adabe, CFA. You see how the CFA people even step up before you mention their name. Like, they've done level 3 of, like, level 1, level 2, level 3 of so much. Charlie, mention my name, let's go. Okay, so up next, you allow me to mention your own. Let me read it for you. Yeah, because I found it rather intriguing. He's a senior electrical engineer in SCADA maintenance at the Ghana Grid Company and a graduate of BSc Electrical Electronics Engineering from Kwame Nkrumah University of Science and Technology. He has over 10 years of experience managing and maintaining industrial control and automation systems within the oil and gas and power sectors. Ladies and gentlemen, please put your hands together for Ahmed Alassane CFA. Thank you. So there's a special question he has to ask. Ahmed, don't go. Relax. Take your time. Please ask your question.
I said, I'm curious. Why did you write the CFA?
Okay, thank you very much for the question. And I think much of that is in my profile. I happen to have been involved in a number of projects from where I started working and where I'm working presently. And I had to sit in some capital budgeting meetings. So I got curious, some of the terminologies that were popping up, IRR, MPV. So I had to seek knowledge. So I consulted a number of friends who were into finance, and they recommended that I pursue this. Yeah. Thank you.
So this is to the engineers out there, those who might be watching the stream live on YouTube. The CFA is for you too. Please put your hands together for Ahmed. Thank you so much. Okay. Our next recipient is the portfolio manager at Data Bank Asset Management. He previously worked at Investiture Fund Management and also is an international graduate trainee in financial markets at Standard Chartered Bank. Ladies and gentlemen, please put your hands together for Aaron Amponsa, CFA. Congratulations, Aaron. Up next, ladies and gentlemen, is an investment advisor with a strong quantitative and financial markets background, underpinned by a BSc in chemical engineering. So the engineers, man, from KNUST, completed in 2012. Currently works. Charlie, your profile long ago. So he transitioned into finance in 2017, joining StanChart through a highly competitive international graduate program. I can tell you, not more competitive than the CFA. Ladies and gentlemen, please put your hands together for Jeremy Yeboah Boateng, CFA. Okay, thank you very much, Nana. Please put your hands together for Nana. He has CFA behind his name too. Okay. We have one more person. She isn't here with us. I believe she's joining online, so I think it's only proper that we mention her name so she can hear the applause as well. She's a senior fixed income portfolio manager with, okay, this is where Duolingo has to work for me. Banque des États de l'Afrique Centrale. Her name is Espoir Vivienne Maliou, CFA. Please put your hands together for Espoir. Okay. So we've awarded our recipients, would want to have all of them come up stage together with their certificates to take one group picture before they go. Please, let's celebrate them. Newly minted CFA charter holders, adding to the ever-increasing number of charter holders in Ghana and in the world at large. I know they're Mongo, so. Please stay, don't go. We want to have the CFA Ghana Society Board join them for one picture. CFA Society Ghana Board, finally join them. Committee heads, kindly join them. Committee heads, please join them. Thank you very much. Congratulations, ladies and gentlemen. Okay. So, ladies and gentlemen, all too soon, we're drawing to the end of what has been an exciting night, a very enlightening experience for all of us. So many insights have been shared, and I believe we'd all be leaving packed with knowledge and insight that will guide our work, our investment decisions, and even our very lives, because we're at this program. We'll be taking the closing remarks shortly, and to do that, we have Chair, Membership Committee, and Manager of PwC Ghana. Ladies and gentlemen, please, let's hear it for Theophilus Forson, CFA.
I feel like being recognized for my charter again. I'm pleading for the society to do something about it so that next year I also be on the podium. I'd like to thank all of us for making the time to be with us this evening as we continue to build confidence in our industry and raise professionals who uphold very high ethical standards in helping us to achieve returns that will go beyond our portfolios and also impact life. I'd like to once again congratulate our new charter holders. Earning the charter goes beyond just showing your knowledge in finance. It shows your determination, zeal, and your ability to do things that on the surface are very hard to achieve. I'd like to talk more on that because if you take the pass rate of the CFA exams, only 44 or 45% pass level 1. And out of those who pass, only 45% pass level 2. And out of those who pass, only about 50% on average pass. So for you to see all these statistics and still decide to go ahead and pursue the charter really demonstrates your perseverance and also your ability to set a target and achieve. So to our employers in the room, if you hire any of our new charter holders, you're not hiring just finance knowledge. You're hiring somebody with resilience ambition and ability to achieve a goal that has been set. I would particularly like to thank our keynote speaker, the MD of the Ghana Stock Exchange, for gracing us with her presence. I also like to thank Peter Iwa CFA for giving us very good insight in terms of the forecast. And a very special thank you to all our panelists for sharing great insights during the panel discussion. It's been a long night. I don't like to talk much, but just to say thank you for coming. We'll be holding a lot more events like this to bring all the industry together, to bring people of like minds together, for us to have conversations, to develop our markets, to create wealth and preserve wealth. Thank you once again, and we're looking forward to having you at our subsequent events. Thank you.
Thank you. So if you looked at the name of tonight's program, somewhere in there is this word, dinner. So yes, there'll be food. We have a buffet set up just outside this very door where the beautiful lady is. So once we are done with the very close-in part of the program, we can move over there, get some food for yourself. There's a buffet set up over there. We also have a juice and drink set up at the very rear, so you can find yourself there, grab something. Let's use the next couple of minutes to network, get to know somebody, say hello to somebody. For all you know, it could just be the beginning of some great... Abna is looking forward to more IPOs. Maybe some of the discussions will result in one of those. So please do look forward. We look forward to that as well. We'll use this opportunity to take a very, very important piece of information. So whatever it is you see over here doesn't just happen. It takes the sacrifice, the toil, the time, skill, and efforts of our volunteers to make that happen. I want to use this time to specially recognize our volunteers. Our media team will help us with that. Please put your hands together, even as we have the images of our volunteers put up on stage so we can celebrate them specially. So you can put your hands together, let's celebrate them. These are our volunteers. These guys make this happen. And as you can see, these are industry people working so many long, hard hours, but still find the time to make sure that events like this can happen. We don't take it for granted. Thank you very much. God richly bless you. Put your hands together, ladies and gentlemen, for our volunteers of the CFA Society Ghana. Thank you.
Oh, there's one more person. Afriye, where are you? Afriye. Come, please. Without her, the society will not run. She is by far the most important person in this society, and she basically put everything together. So, on behalf of everybody, thank you for all the work you do. We are very, very grateful. And without you, none of this would have happened. So all the organization getting everything together is all handled by Afriye. So thank you.
So my addition to that is that while we work on making Ms. Abna Amwa a fellow of CFA, FCFA, we'll leave one of that slots for Afriye as well. Please let's celebrate Afriye. Put your hands together for her. Okay, so all too soon, a beautiful night has come to an end. It's been my pleasure being the master of this ceremony. My name is Prince Dagadu. When I hold the mic, they call me the Regal MC. and it's always a joy to bring joy to your ceremonies. Have a wonderful evening. Thank you. So the ushers will guide us. Yes, the ushers will guide us. We would go. I think we'll just start with our president's table, and then we'll go in that order. While we are at that, the drinks at the back, the tenders will bring the drinks over.
Wealth, investing in your tomorrow has never been simpler. Join the community of savvy investors who are making smart moves and watching their dreams grow. Ready? Download IC Wealth today and build your future. In a world where every second counts and the future is in your hands, IC Wealth is here to empower you. Welcome to IC Wealth, where we make managing your finances remarkably simple. Explore a diverse range of investment options with ease. With IC Wealth, investing in your tomorrow has never been simpler. Join the community of savvy investors who are making smart moves and watching their dreams grow. Ready? Download IC.
Please, we can move towards the buffet area. Please, let's move towards the buffet area to get something to eat. There's the buffet station outside. Kindly go through this door to get to the buffet station. Sound down, please. Sound. Let's go down. Please, sound. Thank you very much. Please, the buffet station is open. We can move towards the buffet station to get something to eat. Thank you.